Keith, if you don't mind, what, you're a VP of life sales for us at DMI, and I know you appreciate the products and the relationship we have with Annexus. What would you say about New Heights IUL?
Glenn, thanks. I appreciate everyone being on this call. Yeah, from my perspective, DMI, we're an independent life and annuity distribution firm. We consult and work with advisors in incorporating a variety of different solutions into their planning for their clients. We've all had some sort of experience with this, whether it's you as advisors out there offering a client a solution that may not live up to the initial presentation or illustration. Working with Annexus and their proprietary indexing methodologies, they've shown a tremendous track record of success in incorporating those index funds into their annuity solutions, and it's translated into the index universal life space. DMI, we offer 20, 30 different carrier products out there. It's our commitment to our advisor relationships to know those products inside and out, know how they're illustrating, know about the indexing components. Sometimes there's products out there that work and do exactly what they say. And then there's products we feel like the Annexus suite of IUL products, and in particular, the Nationwide New Heights, that's going to exceed the client expectation. It's going to help you exceed your expectation as far as the product as well. The goal here has always been a focus, and it's a focus of Annexus. It's a focus of DMI, and it's a focus of mine when I'm working with advisors is, driving client success. How do we implement solutions that can outperform what we're showing on an illustration, and providing, growth over time? And we have a great partner with the Annexus group. We have a great partner with Nationwide. So as we start to stack these quality brands together, you really have, if you are in the IUL space or looking to introduce that type of solution for a variety of different planning needs to your clients, the Annexus proprietary relationship with Nationwide and DMI is a product to look at. It has everything that you can ask for. Low cost structure internally, incredible uncapped indexing options that are proprietary that you won't see in other IUL products out in the market. Long-term care riders that we can add. We do a lot of planning with this product in the long-term care space. So there's very few products and relationships that we have where I feel extremely confident when I'm bringing a solution as a recommendation to an advisor that I'm trying to help solve a client problem, that 4 or 5 years from now, we're not going to get a phone call asking why the product isn't performing. That's going to give you peace of mind when you're working with your clients. We've seen it now for the last 7 or 8 years with the Annexus IUL solutions. So overall, really a tremendous partner. Alan Zuckerman is a national life specialist with Annexus. He is going to kickstart this presentation. Really, I've been working with Al for 7 or 8 years since these products have come to fruition with our partnership with Annexus. Readily available, extremely knowledgeable, definitely my go-to for conversations just about the industry in general, how products are designed, how they're built, why we're seeing something on maybe another product, illustration that doesn't really add up to in our heads, and we collaborate and we discuss, and the whole focus is providing you, the advisor, the right solution that is going to be sustainable and one that you're going to have, your clients in for a very long time and be happy with it because it's performing over that time. So Alan, thank you again for getting on here, and I'll hand it over to you.
Appreciate that, Keith, and appreciate you, Glenn, and the whole DMI team. We're very proud of our relationship with DMI. It's been a long-standing relationship, go back many, many years, and I applaud all of you on the call today with regards to your affiliation with an organization like DMI. So much of our proposition is around that proprietary nature and that whole offering. And when we talk about, is your IUL stuck in time, what we're really referring to is, has the sophistication or the capabilities of the contract kept up with times today? And that's what we're really looking at, is a different way of looking at construction of product. At its heart, I get asked every day, who is Annexus? And when I talk about who is Annexus is a multifaceted entity. I very often use the whole idea of shift happens. Is your IUL stuck in time? It is about innovation. We do things differently. We construct differently. We operate differently. The products actually function differently. And when I use the analogy of Ford Motor Company, when Ford manufactures the Mustang car, it's a pretty average $50,000 car off the assembly line. But when they send that same car, I mean, after all, look at it, it's not a Maserati, it's not a Ferrari, it's not a Lamborghini. But when they send that off to Shelby Motors to 60, 90, 120 days later become a Shelby Cobra Mustang, it's now a $250,000 car. How did it happen? What changed that made it a $250,000 car as opposed to a $50,000 car? And what you see, like the car on the right, you see those two stripes front to back. That's visually what's changed. But what function do those two stripes actually have in the function of the car? Little to nothing. It's window dressing. It's just a shiny object. And that in the IUL world is the illustration. It's shiny object. Just because it looks good doesn't mean that it is actually functioning that way, or that has anything to do with the functioning. But what Shelby does is it strips the car down to the chassis and it rebuilds it chassis up, new differentials, new brakes, supercharges the engine, which in the IUL world is the indexes, but it changes timing aspects. It bores out the heads. It does all kinds of changes. I don't know how many changes, 100 different changes that go on in that vehicle to then make it worth a $250,000. A Nexus is the Shelby Motors of IULs. We break down a carrier's base product and we rebuild it chassis up. Well, in order to rebuild it, you got to do research, you got to do development, you got to do all kinds of things. And so first and foremost, a Nexus is a product innovation company. We rebuild the widget, and we do that through our due diligence up front. We do it through research and development. We do it through partnerships. And DMI is one of those elite distributors. There's only 23 of you, 23 distributors, so that if you're an advisor who is not affiliated with one of those 23 organizations, like DMI, then you do not have access to sell a Nexus product. And that is a proposition that you can take to your clients, and I applaud you for that. You've taken the time to research who you've affiliated with and the expertise that they have. And by the way, let me just a little bit of a shout out. Keith Scatino has been absolutely one of the top leading marketers of a Nexus product over that entire 8-year period that he talked about. He's in the top 3 every single year in terms of an amount of policies written. You have an expert, truly an expert, on your team at DMI. He's done a fantastic job. And Keith knows when he needs to bring me in to assist, or Steve Poppy, my colleague here at Annexus, in order to do that. So that's something that DMI brings to your table as an advisor, and you need to utilize that expertise in order to take your cases to the next level. So that elite distribution is mission critical. And in doing that, we have a team of actuaries, and those actuaries, there's 16 of those, or 17 actuaries that have, between Annexus and them, have 16 patents and 21 pending patents. That's the due diligence that's gone into building this particular IUL product. And so we have done that up front. You don't get patents across a portfolio for just having an idea. You have to be able to prove it. It has to be scientific in nature, and it's a very expensive proposition. We're very, very proud of that. And that's all goes into the building of our portfolio of products. You know, another part of that is the strategic partnerships. And that has to do with all of the different partners that we have in our product line, across our product line, whether it be on the annuity side or on the life side. One of the things that we believe is that we don't have every answer to every question, but we do have the resources to do that. And we bring them to the table. Every one of these entities, it has an actual contract with Annexus to provide a service, a research entity, a management of an index, and we utilize all of them in the building and ongoing work of our products. So when you look at it in total, those are our strategic partnerships, and that's the three entities of product innovation, elite distributors like DMI, and those strategic partnerships in our development go into making of the whole of who Annexus is. And you know, when we talk about what's driven our success and why have we been successful in the marketplace, it really centers around that philosophy of better consumer outcomes. We are all about better consumer outcomes. Does it put more dollars in the consumer's pocket? And that's been proven over the 15 plus years that we've had in the annuity and life business of putting more dollars in the consumer's pocket. I think Keith can tell you, his colleagues at DMI on the annuity side, they have statements that they've delivered to clients that actually have seen values double in a one segment period. It's unheard of in the insurance world. And we've actually nearly seen that on the life side. So there are many of those types of scenarios that have played out, and it's because we give you the opportunity to earn returns as opposed to all the limitations and levers that a carrier has the ability and do pull on a regular basis. So for Annexus, part of our design philosophy, it's never been about the illustration. Back to the Shelby story, the two stripes front to back, that's window dressing. That's a shiny object. It has no real function to the way the car works or the IUL works. So for us, it's not about the traditional ledger. And we'll show you throughout the session this morning why that is and where you can go. But it's about setting achievable client and advisor expectations, understanding the inner workings of the contract so that you can set those expectations from the get-go, understanding that ledgers of illustrations are never and will never be accurate or happen in exactly the way that they look. And then finally, that proper due diligence and product design. We did proper due diligence and continue to do it with those 17 actuaries on an ongoing basis. We built it right the first time. Regulations didn't make a major change in our product. Many of the companies that you saw out there or potentially represent had to completely retool their products in AG 49A and 7702. We did not. We made very small tweaks to it that allowed us to continue and not have to make those major changes because we built it right the first time with an eye to the consumer and an eye to the advisor of giving you a realistic scenario. So the answer to that is the nationwide New Heights IUL 2020.
Alan, before you
Yes.
get into that, I just want to interject something. So the illustration has really become something with the rule changes in various carriers working on their illustration and how it shows based on some additional things such as multipliers or bonuses added in. You know, in some way, shape, or form, there's a couple different avenues that companies have taken. You know, the Annexus methodology is creating that cash value growth and that value for the consumer through the indexes performing. And as many of you on the call know, one of the factors that drives an illustration rate is the S&P 500 1-year point to point. You know, that is not a strategy that we would be using in the Annexus products. We're using all their uncapped strategies, but every IUL product has to have that on the platform. So that drives maybe lower illustration rates compared to some other companies that might have a slightly higher 1-year point to point cap. But overall, DMI, you know, I look at these various companies and carriers and illustrations, and I can help assist, you know, uncovering some things that are being done that maybe you might not want to show your client because it may be overinflating what the actual performance might be. That is one of the great things of being a partner with the Annexus group is their products have performed, and we don't have to worry about that, frankly. The statements that I look at and we pull up from prior contracts have outperformed the initial illustration significantly in this first, you know, 8 years of being out there in the marketplace.
Thank you, Keith. So what we fun-lovingly refer to as New Heights IUL. New Heights IUL is our answer to the market and the way products have been built. The first reason why you need to make New Heights part of your offering to your clients, and I think one of the things that Keith will help you with is understanding the low-cost design. And the low-cost design has to do with, we know from our research and our due diligence that one of the biggest criteria of whether a product will perform or not perform is the expenses in the contract. When we talk about total expenses, we're not talking about cost of insurance solely. In fact, that's one of the least effective ways of measuring. We're talking about total expenses in the contract in aggregate over a period of time, typically 20, 30 years, the lifespan of a contract. And the only way to know what those total expenses are, there's one singular way. You don't see the expenses in a ledger. The ledger does not show you that. You have to use the annual expense report. So my first ask of all of you today, as you go forward and start looking competitively at different products, make a request that every illustration has included in the illustration an annual expense report. And when you start assessing those on a aggregate basis over a period of 20 or 30 years after the surrender period, you will see that New Heights IUL is just simply one of the lowest total expensed contracts in the industry. That's reason number one. The second reason is exactly what Keith talked about, and that is those proprietary indices. Most of the products in the marketplace, and we're going to look at a side-by-side competitive analysis here a little bit later, but most of the products in the industry were built on an S&P chassis and retrofitted with low volatility indices. In the Annexus world, we built it with low volatility and retrofitted it with the S&P 500. And consequently, our products are built always, our proprietary indices are always built by contract, guaranteed to be uncapped. Uncapped. And the realization or the understanding of what effect does uncap have on a contract is amazing. And Keith can help you further understand what that truly means. And then you look at uncapped with participation rates of 125 to 190%. I think you'll find those to be extremely competitive participation rates. One of the development methodologies that we have is sustainable and probable. Is the contract sustainable with the current values of uncapped and high par into the future? And what is the probability of achieving illustrated rate or better? And those are critical questions or terms that we need to come to grips with in analyzing the right product for our clients. And then finally, that's current day, but what are the guarantees? Meaning, what's the worst case scenario once the policy's in place? And in the New Heights IUL, 100% par is the contractual guaranteed minimum. In some cases, 125% par. So when you combine these 3 or 4 topics together, and we kind of fun-lovingly refer to this as the trifecta of IUL. High guaranteed minimums of 100%, completely uncapped by contract with high participation rates on the proprietary low volatility indices, and the lowest expenses in the contract. Our research has said to us these are the 3 most critical elements of a contract, as opposed to solely rate of return. And so you look at this, and then if that's not enough, we added a fourth one. Nationwide has always had as part of its offering a rewards bonus program. And this is designed as a persistency bonus, and it's effective on most cases in year 16, and it's 30 basis points. It's an added 30 basis points on a guaranteed basis that can be utilized as added in, and it will be automatically added into the illustration if they meet the criteria, which is paying the premium and the policy stays in force. So that's just another reason. It's not the reason, it's just another reason. So 4 major reasons why you want to use the product. Of course, the long-term care rider is available on this product, and it's a cash indemnity rider available in 2%, 3%, or 4% increments, and is available to use on this product should a long-term care desire be wanting to be included. And that is a pay to play, so there is a cost to that rider. You know, I referred a little bit earlier to the S&P 500 and the way most products are designed, and what we know is that most products were designed as an S&P funded deal. The question becomes, you know, let's take a look at truly what is the S&P and what has it done. And when you look at the S&P, of course, we've just come through probably the greatest bull run in the history of the markets. The greatest bull run in the history of the markets, arguably in the last 45 years. It's virtually been a straight shot up until this last year. And we have options that have proven that to be true. We've seen returns on some of our products as high as 87% in certain segments. But that's not the measure. There will be a time like this year where the S&P's also lost 22, 23, 24%. And what happens in those times when the market isn't cooperating? The analysts have taught us that they don't believe on a forecasted model looking forward that there will be that kind of bull run forever. In fact, they think it'll be somewhere between a 4.5 to a high 5s rate of return in the marketplace. And if that's true, keep kind of that range in the back of your mind. You may want to write that down, because a little bit later in the presentation, I'm going to show you why 4.5 to say 6 actually could create a negative return in a contract. And probably when I say that, the first thing you all are thinking is, well, wait a minute, it's a zero floor. No, it's a zero floor for the return of the index, but it's not necessarily a zero floor net to the consumer. And we are very concerned about that. And we'll show you why that becomes a topic of conversation. So our answer to that market is our 2 proprietary indexes. First, the Zebra index. And Zebra is what we would call a smart S&P version. It's a smart version of the S&P. And when we talk about a smart version, it's a subset of the S&P. We start out, and this is the index that's managed and created by Roger Ibbotson, one of the foremost economists in the US economy, and has been for many, many years. You may recognize it from his previous company, Ibbotson Morningstar. Roger developed Zebra and manages it. His Zebra Capital company manages it on a day-to-day basis. And it starts out with the full S&P 500. We then apply his behavioral finance filter, and that's designed to take out approximately 300 of the most overvalued and overpriced holdings within the S&P 500. So if we start with 5, we remove out approximately 300, that leaves you with 200. We combine that with a small portfolio of corporate bonds and to control volatility, and that becomes Zebra for the coming quarter. Every quarter, that allocation, that weighting, that analyzation happens again. So that every quarter, potentially, you could have a new group of 200 as part of Zebra, fairly actively managed. What we don't have in this index is a mandate that X% or certain holdings have to be there. Most of the low volatility indices in the industry have a mandated allocation. We don't have that. It's not static. And that's a differentiator between our low volatility indices and many other companies within the industry. So when you look at Zebra and you compare that to the S&P 500, we've actually outperformed the S&P 500 on average. We've done better because we're playing with the holdings of the S&P that are actually creating the returns within the market. And that becomes a huge feather in our cap. By the way, you see the titling NYSE on the front side of Zebra, the New York Stock Exchange. This is the first low volatility index for the insurance marketplace that the New York Stock Exchange has put its logo to, and it tracks and validates on a daily basis. That's a big feather in Rogers' cap, and therefore in the Nexus's cap as well. So when you look at that mountain chart of returns, you see that it's very narrow band of returns. There's not huge fluctuation like there is in the S&P. And you can buy Zebra in 3 ways within the product. The first is a 2-year point-to-point with 155 par. Again, uncapped, contractually guaranteed, 0 strategy fees, 0 asset-based charges, and 0 spreads. And then you have a 1-year point-to-point at 125 par. The third option, the Choice Plus, on a cursory basis, we typically do not illustrate it unless you request it. While a very valid allocation, it does carry a 1% strategy fee, but you get the 2-year par rate on a 1-year segment. That's the differentiator. So 3 options for you. If we're illustrating for you, we're going to use one or a combination of the first 2. This very much is a product which is built on diversification. It is about diversification, not all assets in one style of investing up front. How you diversify it, what is your asset allocation, that's for you to determine with your client and with the assistance of Keith in helping you design these cases. So when you look at Zebra, one of the things that we talk about is not so much the gross rate of return, but what we call the hurdle rate. So you see here the 3 options, you see the participation rates. The maximum illustrated rate under regulation is the 6.01. That's what the regulation says we can illustrate at. But that index return needed to meet illustrated rate, that's what we call the hurdle rate. This is the rate of return that the index needs to earn raw in the market, that when you apply the par rate, you get illustrated rate. We're only asking the index to earn 3.8 to 4.8, something in that 1% differentiated range, 3.8 to 4.8, in order for them to get illustrated rate. That becomes critical. It's a lower hurdle than any other products in the marketplace. 1, because of the sustainability, 2, because of the par rates. But then you look at what has been the last 10-year average, and you see that those 10-year averages are substantially greater. We believe we are under illustrating and overperforming based on the construction of the product. And that hurdle rate becomes the major topic of conversation. I'm sure all of you, if you don't have access to my Annexus after the call today, make sure that you get with Keith and he gives you the invite to register for the My Annexus site. This slide that shows hurdle rate and par rates is one of the pieces that you'll have available along with many, many others, but that needs to be your Bible for all things New Heights IUL. We have tremendous resources that we've developed for this product, and they're all available to you. We don't hide any of those. But one of the things Wall Street has taught us or told us, our analysts that we've interviewed, is while the domestic holdings are great and they expect 4 to 6% returns, domestic should outperform on a go-forward, or international, global should outperform on a go-forward basis. And in the view of diversification and asset allocation, we agree with that. And so our answer to that is the JP Morgan Mosaic, or what we refer to as MO, as an index. And MO's whole premise is to capture momentum and smooth volatility on a global basis. Capture the momentum of the market and smooth the volatility. In baseball terminology, we would refer to this as the singles and doubles hitter. This is the batting champion player, meaning it's hitting for average. It's not meant to outperform. the S&P or the broad market. It's meant to give you a very stable and consistent return. And when you look at that, and you'll see, look at the returns here in a minute, you'll see why that's the case. So 4 countries that we invest in: the US, Germany, Japan, and Great Britain. 15 asset classes in those 4 countries. And what we're looking for is the best 9 returns on a monthly basis. So of the 15, we take the best 9 returns of the 15 asset classes, and those are then selected and placed into Mosaic for the coming 30 days. The first week of every month, this process of reweighting and reanalyzation occurs, and new holdings, or a new mix of holdings, is placed into Mosaic for the coming 30-day period. Every month, very actively managed on a forecasted model. What's going to perform going forward, not what performed in the past. And that, again, a major difference in the way the index was created and operates. So when we look at the returns of Mosaic, you see that in the best years of the S&P, it's going to underperform those years. But how about the years when you have a downturn in the market? Look at the outperformance during those downturn years. And you see the band of returns is very, very narrow. It stays very consistent. And that becomes really the story of Mosaic. It is a good allocation and an alternative to the domestic market of Zebra. And a combination of both gives you the best of both worlds without being able to predict which is going to perform in any given year. So you look at how do you buy Mosaic in the product? Very similar to Zebra. There are 3 ways: a 2-year point-to-point at 190 par. Again, uncapped, guaranteed to have no spreads, no strategy fees, and no asset-based charges. And in the 1-year segment, 135 par. And of course, you have the buy-up option with the 1% strategy fee, this time getting you 1% or 1-year segment, but 175 par. So 3 options. So we've looked in total at 6 different options. You can allocate to any of the 6, some of the 6, multiples of them. That's an allocation that you'll work with the client, and you'll determine what makes sense for the time frames and the age that your client is, but gives you 6 different allocations across the complete strategy or the product. Now, when you look at Mosaic and you look at that hurdle rate discussion again, you see your par rates of 190 and 135. Again, max illustrated rate is determined by AG49 as 6.01. But now you look at that third column and we've dropped the hurdle rate to 3.1 to 4.4. We're only asking Mo to earn 3.1 to 4.4. And if it does that, when you apply par, you get the 601 net in the consumer's pocket. Again, the performance of Mosaic, high 7s to high 10s. We believe we are under-promising by illustration and overperforming. We are overperforming illustrated rate very consistently within the product. That becomes critical to the overall function of the product. So where does Mosaic, or excuse me, where does New Heights IUL stack up in the competitive landscape? Well, let's take a look at that. Most of the products have been built on an S&P chassis, as you see in column number 1. Those that have low volatility indexes, in most cases were retrofitted with those low volatility indexes, but many of these products have caps and spreads. Sorry about that, guys. Caps and spreads. So you have spreads that are anywhere from 8.5%, 9% in some products within the industry. And you have asset-based charges anywhere from 2 to 7% within those same products. And that's not even referring to caps. That's just asset-based charges and spreads. You think about a spread at 8%, the effect of that spread, if you're illustrating at 6, is that product gross would have to earn 13, 14% in order for the consumer to net the illustrated rate of 6. Nowhere in a ledger does it show you that. It shows the product accumulating at illustrated rate 6%. but they don't tell you what does it have to earn gross in the market in order to capture that 6%. And that's where this thing starts to separate itself. And then of course you look at current day par rates, and we are as competitive as anybody, if not better, on any of our par rates, as you see. But then you look at the guaranteed side of things. What would happen in the worst case scenario? Well, we know some of these spreads in the marketplace can go as high as 20 and 30%. So that when you go to 20 and 30% spreads, if 8 or 9 are bad, what happens at 20 or 30? We don't believe things will ever go there, but could they go closer to there? Could they go from 8 or 9 to 12 or 13? And we think that's possible based on the marketplace. And then you look at par rates. What is the worst case scenario in par rates? We know products out there with 5% pars, 20% pars, 25% pars, 30% pars. That kind of contract is opening it up for carriers to pull that lever and decrease those par rates. That is going to materially impact the returns that that contract can earn. Conversely, in the nationwide New Heights product, our contractual minimum is 100% minimum. And then you look at those overall expenses. We talked about those overall expenses, and you see on that far right-hand column, we are as low pretty much as anybody. We're in the least expensive 3 within the industry on a regular basis. In fact, we know of contracts out there where the total aggregate expenses is greater than the total amount of premium contributed, but yet some of those contracts will show you illustratively some of the highest income in the industry. That has to beg the question of how is that happening? What else is going on in those contracts to be able to show that? And those are the types of questions we're hoping that you as an advisor will start asking, and why you need to start looking at annual expense summary reports as opposed to just the ledger of the illustration. Kind of peeling back that onion to see what happens. Keith, did you want to say something there?
Yeah, I mean, every product on this list is something that we've worked with here at DMI. So it's really more about making sure everyone's educated and up to speed as far as what we're actually seeing within these illustrations and the actual workings of the product. You know, I won't name a company on this list. We've worked with them for 20-something years. We still utilize their products. There's certain times and places for different products to be utilized.
Absolutely.
But if you were to look at the expense charges and then look at their illustration, they've taken the stance of adding an illustrative bonus onto their quote. And those bonuses sometimes are illustrating, you know, up to 2.65% additional above and beyond what the index max illustration rate is. And it distorts the performance. The illustration looks phenomenal. It looks great. But when you look at the underlying index to start the process, and you see what the net result is, showing an 8 or 9% aggregate rates of return, cash value above cash value year after year, you got to be a little leery. We oftentimes, me personally, I dial back a lot of what I see in illustrations from different companies in my consultation with advisors. And if it's something that if someone's comfortable with showing, then I'm fine with that too, as long as we've had that discussion and uncovered why we're seeing what we're seeing on an illustration.
Yeah, and it's listen, it's not that these products don't have other options other than what we're showing in this chart. We recognize there are, but that's some of what you're signing your clients up for when you look at some of these products. It's about understanding and giving them the understanding of what their alternatives are, and about what if they reallocate, what are their options in reallocation somewhere over the next 30 years. So it's just something to be aware of. It's not the end all be all, and we're not trying to represent this as the only fact that's available on these contracts, because that would be a misrepresentation. We're not trying to do that. We're just saying understand what is out there in the construction of these products. So on the new
Alan, sorry, one more thing.
Yeah.
If you go back to the last slide, I think one of the things that we want, you know, and advisors that I talk to want is that peace of mind. So if you look at what the part of the value proposition is with the design of the Annexus New Heights IUL with Nationwide. One, you have Nationwide as the carrier backing the coverage. Two is the guaranteed participations. You don't have to be aware of something going below those percentages where other products and solutions, you're going to have to maybe answer a question or two when there might be a change in the future as to what the participation rates are. And then doing the expense analysis, we know that the product has some of the lowest, if not the lowest expenses in the IUL marketplace. So you're starting things out on the right foot, just knowing those different features.
Great points. Great points. So you look at the rest of the contract, you look at the riders and benefits. Of course, there's a full array of riders. We just added, as of Monday, there is now an exchange of insured rider on business cases only, but that is available. And you'll find that as all your illustrations effective again as of Monday, we've actually increased target premiums. So you'll see an increase in target premiums on this particular contract as well. So you'll have a full array of riders. Again, the guaranteed death benefit based on issue age. We have an offer match program, accelerated underwriting. This is one of those things where every single app can be taken by e-app. Nothing has to be paper. Some of those clients will qualify for non-medical underwriting, express issue kind of stuff, and talk to Keith about that and get the parameters around that, but many will. The marketing resources, again, we talked about Annexus. One of the things that you want to know is that we create all our own marketing materials. Everything is created by Annexus. We do not use the carrier-built materials. We want you to be able to tell the story the way it really is designed to be told, and we create our materials to tell that story. So all of the brochures, all of the materials, the sales ideas are all located on Annexus. Again, talk with Keith on that to get access to that if you don't have it already. There's a full array of those materials that are out there. So again, just to recap, those low-cost design, some of the lowest in the industry, the proprietary indexes that are always uncapped with very high participation rates of 125 to 190. And then, of course, those strong contractual guarantees, never to go below 100. So with that, I'll say thank you. I appreciate you guys including us today. Hopefully, there was a couple of nuggets of information. I absolutely, my big ask out of today, get with Keith and give us an opportunity on your next case, whatever you have going on now, at least give us the opportunity and quote us. Put us in the game and understand the explanation that's got to go along with the illustration that this is not a ledger game. This is truly a function of the contract scenario. And give us that chance that you'll be able to tell the story. Include Keith, include me. I'm available to you. Steve Poppy, my colleague, is available to you, but give us the chance to play and let's see if we can't create some additional revenue for you that you can sleep at night and have confidence will get you there. So with that, I'll turn it back over to Glenn or Keith. Happy to answer a couple questions.